Hi, everyone. Good morning. 567 Workshops would like to present Taxes in Retirement, and your presenter today is Jerry Sheridan. Jerry, take it away.
Thank you. Thank you. Listen, folks, before we get started today, I would like to show you something. Now, if I would ask you what this is, what would you say? Now, of course, I can't hear you, but I can definitely hear people say, well, that looks like a dollar bill. Well, you're right. It is a dollar bill. But for today, what I would like you to imagine is that this is your entire retirement portfolio. This is what you've saved in. This is what you've invested in. This is what you've done without for over 40 years in order to put something aside for your retirement. This is your 401k plan. This is your IRA. If you're fortunate to have one, this is your pension. This is everything. This is Social Security. This is your home. This is the whole ball of wax. But folks, we got a problem. That problem is the Internal Revenue Service wants its share. It wants a share of your 401k plan, wants a share of your IRA, wants a share of your pension. If you're just going to sell your house, IRS wants to take a portion of that, and Social Security. This is your piece. This has to last 35 years in retirement. So now we have a crisis. I think you're here to learn how to put this back together again. I think you're here to learn tools, techniques, and strategies that will make you successful going forward. Now, sit back, folks. I'm going to take you on an educational journey for the next 45 minutes. And I think the information that I'll share will be able to give you confidence and that you can use today and in the future. So I'm a speaker and a consultant for Retirement 567, and I have a business in the San Francisco and the San Jose area. It's a financial services business, and I have a passion for education. And that's why Retirement 567 asked me to make this presentation to you today. Now, typically I conduct in-person seminars. Now, the nice thing about that is that after the session is complete, I could get to stick around afterwards and I get to talk to the attendees. I get to address their questions. I get to listen to their concerns. Now, obviously, we're not going to be able to do that today because we're not in person. But I do want you to know that I am committed to answering all of your questions, to address all of your concerns. So as we go through this presentation, I want you to jot down your questions, or if you want, in the question and answer period area on the right-hand panel, if you would insert your questions in there. Now, I'm the only one that can see those comments, so you don't have to be concerned about putting something in there that everyone's going to see. So, well, let's try this out. If you can see me, if you can hear me, if you can see my screen, if you would put yes in the question and answer panel, and also tell me what city that you live in. Let's see if this system works. I'm looking for yeses. Campbell, Los Gatos. Another Los Gatos, Cupertino, another Campbell. Excellent, excellent. I'm glad that you can hear me. I'm glad that you can see me. Now, we have to disclose these requirements here. One thing to keep in mind is that I'm not an enrolled agent, I'm not a CPA, and I'm not a tax attorney. So everything that I talk about, the content of this presentation, is going to be based upon things that I see on a day-to-day basis as clients come into my office. And the last sentence in the last paragraph kind of sums it up. There will be no sales discussion during this presentation. I'm not going to try to sell you anything. This is strictly for an educational environment. Now, this is the agenda, and these are the things that we'll cover. Now, taxes are fairly practical in that they're fairly simple, and we'll get into how you tabulate the taxes. But the questions come into mind when clients have multiple accounts like you probably have your IRA, you probably have a 401k plan, you may have some annuities, you may have your investment accounts, you may have other types of accounts. But you'll see today that as you start interchanging those, when you start bringing those in for your retirement, you start thinking in terms of where should I pull money and when should I pull money as I pass through the retirement era. So as you will see, as you start utilizing those accounts, they start interacting with one another. Sometimes they're positive, a lot of times they're negative, and they will have implications not only for taxes, as we'll talk about, but also it might impact your retirement portfolio. So one thing that I want to leave with you as we go forward with this presentation is that taxation is different in retirement as opposed to the taxes that you might have experienced as you have accumulated your account values. Now, I am going to focus on what is, not what somebody thinks should be. So I'm going to stay away from the political side and talk about what I see in the real world on a day-to-day basis. The last message from this particular slide is all of our examples that we're going to use are going to be based upon married filing jointly, because that seems to be the most common attendee that we see in the webinar. But all of the principles, all of the things that we talk about are still germane to the other standards like filing single or head of household. So let's do a poll here. Where are you in regard to retirement? Are you already retired? Are you going to retire in 5 to 10 years? Are you looking at a horizon that's 10 years away for retirement? Okay, it looks like we're kind of split between already retired and retiring in 5 to 10 years. So that's great. So I'll kind of aim my presentation toward both of those audiences, if you will. And thank you very much for responding to that poll. So let's get into the income tax structure. So as you're looking here, you've probably seen this chart. This shows the ordinary income brackets on the right-hand side, and then the taxable income ranges, if you will, on the left-hand side. And you can see that as you go up in income, as your income increases on the left-hand side, the rate that you will be taxed also goes up on the right-hand side. Now, this is for ordinary income. Ordinary income typically includes wages, might be IRA withdrawals, might be pensions, might be interest. So all of those would fall into the ordinary income brackets. This is a very simplistic view. I have a more complete view in this next slide here. Now, if you've ever filed your own income tax, typically this would be the presentation that you would see. This gives a better view of how the income falls into the brackets, and only the income that's on the brackets on the left-hand side of your screen would be taxed at the rate on the right-hand side. I like this because it kind of starts with the base value. Like in the second line, you would start with $1,975, and then you would be taxed at every dollar over $19,750 at the 12% rate. And then the third line, you would start with the base, and then you would be taxed at 22% on anything over the $80,250 range. There's another depiction that might make it a little bit easier, and we call this a tax map. And what it does is kind of graphically shows that as you increase ordinary income across the bottom of the graph, you can see where that income would fall in terms of the brackets. One thing that I want to point out is that you can't see because of this green circle, but between 0 and 27,400, there is no tax. And the reason for that is that we have standard deductions that were given to us in the Tax Cut and Jobs Act in 2017. I'll talk about deductions a little bit later in the presentation, and we'll understand what those deductions do. But understand that you have thousands of dollars that are incoming as far as income into your household that you're not going to pay tax on. And that's kind of what this diagram shows here. So then from $27,400 to about $47,000, that's where the 10% tax rate goes. And then, of course, from $47,000 up to a little over $107,000, that's where the 12% tax rate would be. Now, there's a couple of spots, the green spots there. We'll talk about some areas that we would really want to watch out as we do our planning. And that's where we see the largest jumps. Like the first jump we see from 0 to 10, very significant increase. The second jump we would see from 12 to 22. Again, it's a 10% jump, very significant. And then finally from the 24 to the 32. Now, these three areas would be areas that tax planners and CPAs would look at because they provide the best opportunity for us to engage the tools. And I'll talk about the tools at the end of the presentation, but we can engage the tools here to mitigate or minimize our exposure to those significant jumps. Now, all of this discussion kind of opens up the introduction of a term called the marginal tax rate. What the marginal tax rate is the tax bracket that your last dollar of income fell into. So if we went back to the tax map that I just showed you, we could go across the bottom and the last dollar of income that you have, whatever that dollar falls into, whatever rate that dollar falls into, that would be your marginal tax rate. And it's a term that we'll talk about during the discussion. You'll hear this from the CPAs. They'll talk about, oh, your marginal tax rate is, and they'll identify where your last dollar, the bracket, your last dollar of income fell into. So that's kind of ordinary income, but there's another source of income that we can talk about, and that's capital gains and qualified dividends. Now, I'll show you the chart. It has that marginal tax rate that we just talked about for the ordinary income. It has a similar bracket structure as that ordinary income, but it's lower. And the reason that it's lower is that the government encourages us, say that 10 times fast, it encourages us to invest in the economy. They want us to invest in the companies that support the economy. So the rates, as you'll see, are going to be lower than the ones that we just saw for ordinary income. So this is the brackets for capital gains. So you can see that there's some interaction between capital gains and ordinary income, the taxable income. If you have capital gains, you're not going to pay any taxes on those capital gains as long as the taxable income is lower than $80,000. So you can have a lot of capital gains and very low income, and you're going to pay very low taxes on the capital gains. Now, just so you can see the relationship, the taxable income from 0 to $80,000, that covers the 10% and the 12% brackets for the ordinary income. Now, you're not going to impact your capital gains tax until you get above that $80,000 range. Now, that moves you into the 22% tax rate for ordinary income, and then all the way up to 496, that's the 22, that's the 24, and that's the 32% brackets in the ordinary income. So when you move into that second threshold, if you will, at $80,000, now your capital gains will be taxed at 15%. And then finally, the top tier there at 496,000, that kind of is parallel with the old 39.6% tax rate that we had before 2017. So the upper income level at above the 496, that has not significantly changed. But the range that has been introduced in the lower brackets for income make it a wider perspective. So we're going to pay less capital gains as we go forward because of the way that it was restructured. So again, this is a tax map. This time, this tax map is for capital gains. And you can see on the bottom that between $0 and $107,000 is tax-free. And the reason for that is we saw up to $80,000 in the last table, but now we would add on the standard deviation, and that would take us up to $107,000. So $107,000 of income can come in before you start getting taxed on your capital gains. And again, I'll talk about deductions in a couple of slides. So let's talk about deductions right now. Timely slide. So we have deductions, we have exemptions, and we have credits, and I'll talk about each one of those. Deductions you can think of as a way to reduce your taxable income. So you're going to report on your income tax, you're going to report taxable income. And I'll show you an example as we get into this presentation. But in order to subtract, in order to reduce that taxable income, we're going to be able to utilize tax deductions. So you now have a choice because of the Tax Act that was signed in 2017. You can either take the standard deduction that you see there, it's $24,800 for a married couple, $12,400 for a single person, or you can itemize. Now, if you itemize, then you have to tabulate, we have to track, we have to calculate things like mortgage interest, we have to investment interest, charitable gifts, those types of things. We would have to track and limit those and record those. And then there's a special section in the income tax that is Schedule A. We would have to list it there, and then we would be able to calculate what that particular deduction. Now, we find that in retirement, there are not that many deductions. Now, it may be different for your particular situation, but most of the people that we see that are in retirement, they don't have that many deductions, so that they would take the standard deduction. Now, you might say, well, 24,800, that's a lot. But before the Tax Act in 2017, the standard deduction was $13,000 for a couple. So we've definitely increased and improved our positioning after the Tax Act that happened in 2017. Additionally, as you get to the age of 65, you're entitled to another deduction, and that's $1,300 per person. And also, if you're blind, there's another deduction for $1,300 that for people that are affected that way. So again, these are going to subtract, they're going to diminish the taxable income that we have to report on our income tax. Now, we used to have exemptions. Now, we've put a big X there because as part of the Tax Act in 2017, these personal exemptions were eliminated. So they gave us something and they took something away. In 2018, the personal exemption would have been $4,050 per person. And now we don't have that. Now, if you're thinking in terms of, well, did I really lose something? Well, if you took the old standard deduction of $13,000 per couple and you add in the $4,050 per person and you added those up, they would still be less than the $24,800 figure that you saw earlier. So effectively, we came out ahead. So that's exemptions. And we, like I said, we've eliminated those exemptions. The IRS has eliminated, we didn't. The IRS has eliminated those taxations. Well, another thing that will affect our taxes is credits. Now, credits are set up to encourage us to behave along a certain way. The two most popular credits are the Health Care Act and the Earned Income Tax Credit. Now, tax credits, we said that the deductions subtract from the taxable income. These credits are going to subtract from the tax bill, from the money that we would owe on taxes. And again, I'm going to show you an example to helpfully clarify what I'm speaking about. But credits are there to incentivize the behavior. So again, the most common are the healthcare and the earned income. One that's not so common is the server's credit. Now, the server's credit is there to encourage low-income earners to contribute money into their retirement funds. So you say, well, why would that affect me? Well, a lot of people in retirement work part-time jobs, and they're probably a lower pay than their historic salaries have been while they were employed. So now they're low earners, and here's an opportunity for that low earner to make contributions to their IRA and get credit. Now, the server's credit says that they will give you up to 50 cents on every dollar that you contribute into your retirement fund. So you can take that credit up to $2,000 per couple in 2020, and you can subtract that amount of money from your tax bill. Now, again, stay with me. I'm going to show you an example to kind of make this a lot more clearer. So here's kind of an example. We have this couple. They're going to file jointly. They're married and they're filing jointly, and they have a gross income of $38,000. So we want to reduce that taxable amount. And the first thing we do is we apply any deductions. The first deduction that we subtract is the standard deduction, which is that 24,800 figure that you saw earlier. Then we can assume that both of those taxpayers are over 65. So we take $1,300 each for $2,600, and that gives us a total of deductions for that for $27,400. Since they've contributed to the IRA, they make a $2,000 contribution. They can take a deduction for that contribution. So you subtract the $27,400 and the $2,000 from the $38,000, and now we have $8,600 in taxable income. So you can see how the deductions subtract from the income that we have to report and that will be used for the calculations. So we have now $8,600. That falls into the 10% tax rate. So our tax bill is $860. Now we've applied the deductions. Now we can apply the credits. So we have the server's credit saver's credit that we just talked about, and we get 50 cents, half of the contribution that we made. We made $2,000. We can take $1,000 credit, and lo and behold, we erase taxes due by using deductions and credits. Now, everybody on the previous webinars always ask the question, what happens to the $140 difference between the $860 and the $1,000? Well, credits are non-refundable gifts from the Internal Revenue Service. If we don't use them, then they just go away. So we don't get that check for $140, but we definitely are able to use that, and we don't have any taxes due. So that is a good thing. So just again, going back to the tax map, again, this is for ordinary income. And remember, I showed you that between 0 and 27,400, you have no taxes. And the reason for that is because of the deductions. So if all we had was just ordinary income and capital gains, then the calculations for the taxes would be, fairly simple. We just add and subtract, take out the deductions, take out the credits, and then we would be able to calculate our income tax. But the Internal Revenue Service has introduced some complications that make it kind of confusing and add in some calculations. So everything that you see on this page factors into items that will impact our taxation. And what they will create is kind of a situation where what you think you pay, there's actually more involved. So we call this the real tax system. Now I'm going to step through each one of these and kind of explain what they are and how the interaction will play into our tax computation. The first item is called the required minimum distribution. And what that means is that when you reach the age of 72, you're not going to be forced to start withdrawing money from your retirement accounts. Now, retirement accounts are your 401k plan, your IRAs, those types of things. Some of you may be teachers and are in the government, and you have a 403b account. That's the same thing. Now, the way that you calculate how much you have to withdraw is you start with the balance of that account at the end of the previous year. Now, try to stay with me here. I'll show you the example. So, and then you divide that number by your remaining life expectancy. So in our example here, let's assume that you have an IRA. And at the end of 2019, you had a balance in there of, let's make it nice and simple, $500,000. So you would take that $500,000, you would divide it by 25.6. I'll show you where we get that number on the next slide. But that will tell you that you are now required to withdraw $19,531. Now, you say, what's the big deal? Well, first of all, you're taking money out. This money now becomes ordinary income. And you'll see how this interacts with the other accounts that we have going forward. So let me show you the IRS table that they use in order to help us calculate the required minimum distributions. As you can see, the ages are here, goes all the way up to 115. And then they have your expected life expectancy over here on the right-hand side. And as you go up each year, then your life expectancy goes down just under a year. We said that it starts at 72. So 72, your expected life expectancy is 25.6 years. That's where we got that number that we divided into the $500,000 balance going forward. So that's the required minimum distributions. Another complicating factor that was listed on those additions into the real tax are capital gains. Now, we talked about capital gains earlier, and those were capital gains on things that we own and we would sell, and they would have an appreciated value. So any of those gains that we realize would be taxed at either 0% or 15 or 20%. But most people don't realize that there's what we call a phantom gain. And this is primarily if you're invested in mutual funds. Now, let me give you an example. Suppose we had mutual fund A, and the fund manager in 1985 bought a whole bunch of Apple stock. And then you bought into the mutual fund in 2019, and you stayed invested in there through 2020. Now, sometime during 2020, the fund manager decided that he wanted to divest himself of some of that Apple stock, so he would sell it off. Now, any gains that are realized, and you can appreciate that there would be some gains on Apple stock from 1985 to the year 2020. So any of those gains by law have to be passed through the mutual fund to the current shareholders. So now you're a shareholder in that account, and you would have those gains sent back to you or sent through to you, and you would have to report those gains on your income tax. So that's what we call a phantom gain. People don't realize it happens until they get the notice in the mail, and they have to calculate it and post it onto their income tax. So we want to be aware of that as we look at our holdings, and we'll talk about those types of tools later on in the presentation. The key thing here to realize is that capital gains can trigger ordinary income, and the ordinary income is going to affect your adjusted gross income, the amount of money that we calculate that we need to put into the 1040 form. So we have to be cognizant of the streams of income, and particularly these phantom gains. Another area that we have to be aware of is Social Security. Now, if you just had Social Security on your, if that was the only source of income that you had, you would pay no federal income tax. But now, as you start involving and, like I said, interacting with other forms of income, then you're going to have an impact. So the way that we determine if we are going to be taxed, or if we calculate how much we're going to be taxed of our Social Security, we have to go through a provisional income formula. As you see here on the chart, the provisional income starts with taking 50% of your Social Security benefit value. You add in your ordinary income, you add in your dividends and capital gains, and then you would add in all of your non-taxable interest. You would have non-taxable interest if you had muni bonds, for instance. So then you would add that up, and that would give you your provisional income. Then you have to apply it to a threshold. So you take that provisional income and you apply it to a threshold. Let's use the couple threshold on the bottom there. So the first thing that you would do is you would take that provisional income and subtract $32,000 out of that. That's the first threshold. Now, if there's any overage on that, then we would take 50% of that number. We wouldn't tax it at 50%. We would take 50% of that number. Then we would also apply a second threshold. We would take that provisional income, we would subtract $44,000 from that, and whatever that overage was, we would take 85% of that. Now, is that as clear as mud? Are you confused? If you're confused, put a yes in the question and answer box, please. I don't see any yeses. This must be fairly clear. I've done a great job. But I was prepared for the people that said, yes, I am confused, by giving you an example. I'm actually going to give you two examples here. The first example, on the top, we're going to take $20,000 for a Social Security, and we're going to have $40,000 worth of IRA withdrawal. So this couple has $60,000 coming in as income into their household. So we first of all have to calculate the provisional income. So the way we do that is we take half of the Social Security, so half of the $20,000, we would add it into the withdrawal, and then we would get $50,000 of provisional income. So now we got the provisional income, we have to put it into and pass it through the threshold. First threshold for a married couple is $32,000. So we would subtract 32 from $50,000. We would get an overage of $18,000. We said we would take 50% of that. So that gives us a figure of $9,000. And then we would apply the second threshold, which is $44,000. And we would come up with an overage of $6,000. We said that we would take 85% of that. Well, we've already taken 50% here. So we're just going to multiply that second number by 35%. That gives us a total of 2,100. We would add 2,000 and 9,000, and we would come up with a total of 11,100. That's the amount of Social Security that would be taxed. Now, 11,100 is actually 55% of the $20,000 Social Security benefit that we had. The second example, we're still going to bring in $60,000 into the household, but we're going to do $40,000 of Social Security and $20,000 from the IRA. That would give us a provisional income of $40,000, taking half of Social Security, adding it to the $20,000. That would give us $40,000 of the income. We would apply that to the first threshold of $32,000. That gives us an $8,000 overage. we would take half of that, 50% of that. That would give us $4,000. Then we would apply it to the second threshold. Well, the second has threshold. We're under the second threshold, so we would not have to calculate anything there. We would not have to come up with a figure by the second threshold. So we would take that $4,000, we would apply it into the last box. Now the amount of our Social Security that we would pay taxes on is now $4,000. Well, as you can see, $4,000 is 10% of the $40,000 that we received, a very significant difference. Now, if I take these two examples and I put them into the fields that we might see on an income tax return, they would look like this. Here's our first example, taking a $40,000 IRA withdrawal, taking $20,000 as far as Social Security. Remember the figure for our first example, we have $11,100 of taxable Social Security. We would add that to the other income, which is the 401k, the 401k, the 40k withdrawal from the IRA. That would give us a total of $51,100 of taxable income. We would subtract the standard deduction. That would give us a taxable income of $23,700, and our tax bill would be $2,449. On the other hand, if we take the second example, where we took a $20,000 IRA withdrawal and we had $40,000 of Social Security, then our taxable, remember, our taxable Social Security is $4,000. We would add that to the $20,000 IRA withdrawal. We would come up with $24,000 of taxable income. And then we would apply our deductions. And look at that. We have no taxable net income, which would tell us that we don't owe any taxation on that particular transaction. So this is a significant difference between the $24,049 and zero. So what this draws into play is the fact that we have to be aware and cognizant of the methods and the sources for our income as we start putting together our strategy for spending money in retirement. So those examples of the real tax that we just talked about, most of those are the most common, and most of those are for all of the taxpayers. The things that we're going to talk about now are primarily aimed at the high income earners. Now, you might say, well, then this might probably doesn't apply to me. Well, this is for Medicare, and Medicare is means-based, which means they're going to look at your income and they're going to calculate whether you're in the threshold. And if you are in the threshold, then they're going to add and increase your premiums for Part B of Medicare and or Part D of Medicare. And by the way, these costs come out of your Social Security check. So as you go up in income, your premiums are going to increase on both of those parts of Medicare. So you say, okay, well, I'm pretty well satisfied. I'm not going to have any influxes. Well, we don't know that going forward. You may have, during your whole 35 years of retirement, you may have opportunities to have what we call unusual and large income events. You may sell your house. You may get an inheritance. And oh my God, you may win the lottery. And that's definitely going to increase your revenue. So if any of those happen, then you're going to fall into one of these increased brackets. Now, I want to point out at the bottom of that chart shows that in 2020, the IRS is going to look 2 years behind you, back into 2018, in order to calculate the amount of money. So they're going to look back in 2018 to see what your income level was, and then they will make a determination as to where you fit into any of these threshold brackets. So again, we want to make sure that we stay cognizant of where our income is coming from, and we want to make sure that we're aware of any impact that that increase in income is affecting not only our taxes, but it could also affect, as you can see here, our Medicare premiums. Another area that would be affected, that would be affecting the high income people would be the net investment income. Now, net investment income over here on the right-hand side, these are capital gains, these are dividends, these are interest, these are annuity payments, these are passive business income, and these possibly could be rents. So it's not derived on labor that you would do, your normal job. These are outside, these are investments that you have made. And if that adds up to over $250,000 for a married couple, then you're probably subject to the 3.8% net investment tax. So again, be cognizant of where your income is coming from. Now, we already talked about the personal exemptions. So we don't have to worry about these particular items. So I'm not going to spend a whole lot of time on these. These will eliminate it again when the Tax Cut and Jobs Act was implemented back in 2017. And the final area that I want to talk about, and you remember you saw back on that first chart when we were talking about the real tax items, the real tax factors, the alternative minimum tax was in red. Now, the reason for that is that as a result of what took place in the Tax Act of 2017, the ranges for these were raised. Now, these are for high income earners that have lots and lots of deductions. Now, if you are going to be affected and you are going to be required to file under the alternative minimum tax, you're going to know it. Your tax preparer is going to know it. If you do it online, it's going to come up. You are subject to the alternative minimum tax. You're going to know that you are going to be affected with this. If you are affected, if you are part of the 200,000 estimated taxpayers that will be affected, then you definitely want to be working with your CPA to get his or her advice. So now we move into another concept. We talk about the marginal tax rate. Now we talk about the effective marginal tax rate. Now, the reason that there's a difference here is, well, I think you've kind of seen a theme as the IRS needs additional tax revenue. So they don't just go in and change all of the brackets across all of the different ordinary income or the capital gains. They go in and they get rid of, as we saw, they get rid of personal exemptions, or they bring things in that were not historically taxed, things like Social Security that we've seen. Those have 30 years ago, if you only had Social Security, you were not taxed on that. But so that's how the Internal Revenue Service increases their revenue. So then the question now becomes, or the more important question comes in, not which tax rate you end up, but how much of your, as it says there, how much of your last dollar of income do you actually lose to Uncle Sam? So you look at that last dollar, the last dollar that went into your calculation, how much of that dollar did you lose in taxes? Now, again, examples, one picture is worth 1,000 words. So I'm going to give you an example, but first of all, we're going to revisit the tax map, and you see the tax map here. And again, this is easy. As you go through and you add in ordinary income across the top, you can see where you would intuitively, that goes back to the marginal tax rate, intuitively where that income would fall in as far as the tax bracket. This is the capital gains tax. And again, the same thing. As your capital gains increase, you can intuitively see where you would be impacted by the tax rates. So now we're going to talk about the effective marginal tax rate. And in order to do that, let's do a case study. So here we have John and Jane, and they're a married couple, and they're going to be filing jointly. And both of them are over 65 years of age. They have $60,000 worth of Social Security. They have $10,000 of net long-term capital gains, and they have withdrawn $52,000 from their retirement plan through their required minimum distributions. So let's look at the tax map and see what we see. First of all, the red, remember the red is just the tax rates. The gray is what actually happened. So you notice that after they harvest about $10,000 worth of income, all of a sudden their real tax rate jumps up to 18.5%. The reason for that is because the combination of ordinary income and capital gains makes it mandatory to start taking the Social Security. So the ordinary income would be taxed at 10%, and then that would draw in 8.5% of the Social Security, and that gives us the 18.5% total here. And then we jump up to 22%, and then finally up to what has commonly been known and referred to as the finger, but as this jump here. Now, intuitively, we would think that this income that would be in this range would be taxed at 12%. So if you're asking the question, what happened? Well, you're not alone. This is what actually happened. So intuitively, we would think that if we would add across that bar, if we would add an additional $1,000 of income, and maybe it would be a withdrawal from our IRA, we would assume that we would be taxed at 12%, and that would give us a tax bill of $120. But what actually happened is that, well, that $1,000 was taxed at 12%, and we do have $120 tax bill. But that also caused us to bring in $850 of taxable Social Security, and that's also taxed at the ordinary income bracket at 12%. That gives us a bill of 102%, and both of the withdrawal and the Social Security causes $1,850 of capital gains to be drawn into the calculation. That's taxed at the capital gains rate of 15%. That gives us a bill of $277.50 for a total of $499.95. So by drawing in another $1,000 from your withdrawal, you've actually lost $499.50. Now that's pretty significant. That's the effective marginal tax rate. That's what really happens. And you can see that as you look at the tax maps. So the same thing happens with the capital gains. This is the tax map for the capital gain. Now, if John and Joan were kind of contemplating, they have a stock and that stock has appreciated, let's say $25,000, I think they would want to know what the impact of selling that stock would have on their taxes. Now, after they see the results of this tax map, well, they might want to reconsider selling. They might want to sell a portion, or they might want to defer that to another period, another year when the tax map would provide some opportunities for them to take advantage of that sale. So this is just information that people can use, John and Joan can use, you can use in order to determine what is really happening to your taxes above and beyond just the ordinary income and the capital gains. So these tax maps are useful tools. Now, you've probably been waiting for the way that we can mitigate or we can reduce our taxes. So there are lots and lots of tools that we can use to control taxes. And by carefully planning and implementing these, we can create a tax efficient retirement going forward. One of the ways that we can do that is we can diversify the accounts that we're holding. Where do we have our money? We can put it in IRAs and we can put it in Roths. We can put it into taxable accounts. They call it non-qualified. And all of those have different tax structures associated with them. So now we can diversify our holdings in order to take advantage of any opportunities to save money. We can also use tax deferred products where appropriate. Tax deferred products would be your 401k plan, your IRA, your 403b, anything that would be tax deferred. So you're not paying taxes on the front end, you're paying taxes when you withdraw that money. And then when you start making withdrawals, you want to make sure that you blend those withdrawals so that they're effective and efficient to your tax structure. A lot of times people will start in with one account and they'll take all the money out of that account and then sequentially go to another account, take all the money out of that. That's not a very efficient way to do that. So you want to properly blend those withdrawals so that you can see where you are and optimize those withdrawals. And then finally, you want to consider which assets that you would have in what type of account. These are all available tools that tax planners can talk about. So now what I would like to do is move into the most recent pieces of legislation and see what the impact of those laws were. The first piece of legislation that we can talk about is the Secure Act. The Secure Act was passed at the end of 2019. It became effective in January 1st of this year. One of the first changes, one of the key changes pursuant to what we're talking about here in retirement is that the age in order to start required minimum distributions has been changed to 72. Before the Secure Act, you had to start taking out required minimum distributions when you reach the age of 70 and a half. So now we've got 2 more years that our IRA can potentially increase in value. This also creates the opportunity to additional time to consider and execute any Roth conversions that we might want to be thinking about. So this is a plus, and this is one of the first changes that we came out of with the Secure Act. Another change that came out of the Secure Act is what we call the death of the stretch IRA. Now, before the Secure Act, if you had a large IRA or large 401k plan and you were planning on leaving that to your children or your grandchildren, those beneficiaries of your account had the ability to stretch those distributions out over their life expectancy. Now, with the Secure Act, we've now compressed that, and now those accounts have to be empty after 10 years. So we have a lot of flexibility in that 10-year period. We can take it all out in year 1, we can take it all out in year 10, or we can take out portions all during that 10-year period. The only requirement is that at the end of the 10th year, those accounts must be empty. Now, there are exemptions to the stretch IRA, the death of the stretch IRA, but the majority of the beneficiaries that we're going to encounter, that we have encountered, fall into that 10-year period. So if you look at the first change, which is the change of the RMD, and the second change, which is the death of the stretch IRA, you have some implications here. So if we delay when we start taking RMD, then we have the potentially higher value in our IRAs or our 401k plans, and we also have a shorter distribution period. Now, that comes into play when you now have a larger value of your RMD, and now you're now forced to start taking your RMD, and then the combination of RMD and your Social Security and your other income now may push you into a higher tax bracket. And also, if you don't need that amount of money in order to sustain the lifestyle that you would like to continue, then you're paying taxes on money that you don't actually need. So we really want to be cognizant of, and we want to take steps to minimize that exposure. And then finally, the third bullet there says that as we're leaving money to our children or grandchildren, they may be a time when they're maximizing their income. So as they're forced now to take those distributions within that 10-year period, that is going to impact their tax liability. So again, things to think about, things to talk about, things to plan for. The third change from the Secure Act was now you can contribute to an IRA at any age. As it says there, before the Secure Act, if you reach the age of 70 and a half, you could not make any more contributions to an IRA. But now you can, as long as you or your spouse have earned income. You can make contributions to your IRA. Now, the way that this becomes important, again, we pointed out that a lot of our retirees have part-time jobs. They're participating in the gig economy, if you will. So now if they have earned income, they have those part-time jobs, now they're able to make those contributions into their IRA funds. And also, if they make those contributions and they have a lower wage than they have historically, then they might qualify for the service credit that we talked about earlier. So one point that I want to talk about is you could be a high earner for the entire your life as you were employed, but now there are ways to show you as a low income earner, and then of course reduce your taxes, give you more money for your retirement. Would like to talk about the CARES Act that's unfortunately had to be implemented earlier this year. Now there's a whole bunch of very strategic and very nice goals and implements that were called into play and activated there. Now we don't have the time to go over all of those, but there's one in particular that's kind of germane to our conversation here, and that regards the required minimum distribution. The CARES Act eliminated required minimum distributions for the year 2020. That means your first RMD, that means your ongoing RMD if you were over 70 and a half, that means any inherited RMDs. Those have all been eliminated. You do not have to pay the required minimum distributions for 2020. This also gives us an opportunity as the market is going up and down. Oh my God, the market is going up and down. When the market is down, this is going to give us an opportunity to think about implementing a Roth conversion. Now, if the market is down, there's a good chance that your account value is going down. So if you make the Roth conversion at that point, the taxes on that are going to be lower than if your account value had been higher. So as we watch the markets go up and down, they create opportunities for us to plan for, look at, think about making that Roth conversion as the account values go down. So kind of to wrap it up, one thing that I want to point out is the fact that you've seen the tax maps. And as you can see on the pop-up that you've seen during the presentation, I would like to offer you a complimentary tax map. Now, why would you want to do that? Well, let me step back and talk about the tax map again. The tax maps are going to be graphically showing you where your effective marginal tax rates are, what actually happened as you were filing your taxes. You're going to get feedback. And then we're going to analyze what happened during that tax period, and we're going to see whether we can optimize or whether your tax strategies have been optimized or whether there might be opportunities for you to tweak. So it's going to give you that feedback. First of all, the analysis is going to tell you whether you're in line with your tax planning or whether there might be some tweaks. And then that's going to give you confidence that you're going to know, what's happening and where. So again, if there's an opportunity, I would like to schedule and offer you the complimentary tax map. So that kind of wraps it up. And my favorite tax-related quote, and it comes from one of the greatest names of judges that I've ever heard. So Judge Hand says in this quote, yes, you do have to pay taxes, but you don't have to overpay your taxes. And then once you see your personalized tax map, you'll kind of know on what side of the equation you fit into. So what I would like to do is open up the question for any questions that you might have. We do have a few minutes. And again, if I don't get to these, what I would like to do is follow up with you, and I will follow up with you because I do want to address any concerns that you have and answer any questions that you might have. So if there's any questions that you have, please put them into the Q&A section. We got Kathy asking the question, what is a qualified account? Again, qualified is a term that the Internal Revenue Service uses, and it's just after tax money. So qualified would be before taxes, and that's what your 401k plan, your IRA, those types of accounts, those are qualified accounts. Non-qualified would be ones that have already been taxed. Arun is asking, what is the tax map again? Again, the tax map is this graphic representation of what's happening in your particular situation in regard to taxes. It's going to show you where your revenue is. It's going to show you very clearly, as we saw in a couple of those examples, it's going to show you where your taxes are. Okay. All right. So there's some questions here that are pertaining to individuals, so I'm not going to answer those during the course of this webinar, but I will follow up with those people and I will address those particular questions. So I hope you learned a lot during the course of this presentation. I understand that this is a time commitment that you've made. You've given up time that you would normally have spent with your family or with your job. So I hope that the information that you've heard has been beneficial. The second goal that I would have is that you've learned things that are going to prevent you and mitigate mistakes that you might make on your income tax filing. You know, I see people make mistakes on taxes in retirement a lot. And when I see those mistakes, I want to make them known to my clients, and then I want them to take steps, and I want to show them steps that they can take to mitigate those. So, you know, when I started this presentation, I told you that this was going to be just an educational point of view, and I wasn't going to sell you anything, and that's true. I'm not going to try to sell you anything, but I want to be honest with you. I would like to sell you on something. Now, that's something that I would like to sell you on is you. Now, you've taken the first step here. Do you know how many people we invited to this webinar? It was over 10,000 people that we sent out the invitations to, but only you took the initiative to come in and listen to this presentation in order to protect your family and your retirement portfolio. You should be proud of yourself that you've done that. So now retirement comes along. There's a lot of critical decisions, or a lot of implications that happen during the calculation for retirement, and they can cause stress. They can cause some turmoil, and they do, as you saw, they do have implications. So I'm hoping that you got some information, and you can take this information, and now you will know what to do. You will know when to do it, and you will know why and what happens when you do it. So hopefully that will give you some confidence. That will reduce the stress level going forward. And the good thing about it is that you don't have to be alone. For the last 16 years, my team and I have been working with people exactly like you, and we've helped them reduce the stress and enjoy this time as they get into retirement. So we would love to help you going forward. So give it a thought. We would love to help you achieve your goals and make this time a more relieving and less stressful, going forward. So thank you for attending. Please stay healthy and please stay safe going forward. Thank you.